June 11th, 2024. My first thought coming into the day was that we might have to trade below the prior day's low. And the reason for that was the daily chart. On the daily chart, the market set up an IOI pattern, an inside bar, followed by an outside bar, followed by an inside bar. The significance of it really is that it means the market's in breakout mode. But because the market's in breakout mode, and this is a breakout mode pattern, it's theoretically a sell below the June 10th low. It's obviously not a good sell because it's a bull bar. So there are probably more buyers below yesterday's low than there are sellers. But you have to keep that in mind that the daily chart might want to trigger the sell signal. So I thought it was reasonably likely we were going to have to get to at least this price. You can see we opened essentially in the middle of yesterday's range, which was an inside day, I guess a little bit below. But we opened in the middle of the inside day. When you open in the middle of a day's range, it does increase the odds that you're going to get another inside day. But yesterday's range was not all that large. And again, I did think we were going to have to trade below the prior day's low. Bar one, a bear bar, but a tail on the bottom. So not really as good as it could be. We do have three bear bars leading into yesterday's close, and then a gap down, and now a bear bar. So although it's not great always in short, I do think we are probably always in short at this point. If we can get a second bear bar, I would say then we are always in short. And we do get that second bear bar on bar two. So now 1 and 2, I think we have consecutive bear bars, at least one closing near its low and one being big. So bar 1 pretty big and bar 2 closing near its low. I do think we are always in short at this point. It's okay to sell. I think the target is the prior day's low. I'm not sure how much further than that we're going to go. More follow through for the bears on bar 3. I think it's tough to sell the close of 3. You probably can, but we're pretty far below the moving average. And a lot of times bars like this, when you sell them, they end up reversing on you on bar 4. So I think, while it's okay to sell 2 or 3, I think probably the best case scenario or the best course of action is to just let the market go. I do not personally trade the first 6 bars of the day, or I won't trade until bar 6. So I will not trade the first 5 bars of the day. And if there's a good looking trade on 6, I might take it. But for the most part, I like to let the market give me some information before I start doing things. And to be honest, 1, 2, and 3 doesn't look all that much like a bear trend from the open. It's a possible bear trend from the open, but to me, it looks more like a forming trading range rather than anything else. And then you get a huge bar on bar 4. What is bar 4 telling you? Well, I think bar 4 is a give up bar. So the bulls are giving up on keeping the market above the prior day's low. Instead, what they're doing is they're letting it get there and then looking to buy down there instead. What bar 4 did was really important. It opened a gap with the bar 3 low. So some bulls bought below 3, expecting that we weren't going to they were pretty much betting against a bar like bar 4 happening. And instead, we got bar 4. So those traders are going to be panicked and they're going to be trying to scale in. And if they scaled in, maybe on the close of bar 4, maybe they used bar 5. Yeah, see? So they bought below 3 and then they were panicked by 4, but they know it's a really climactic bar. So what they did instead was they bought more down here and then they used the bounce on bar 5 to exit their longs, and that's what's causing this big tail. Additionally, we opened a second gap with the prior day's low. So really dramatic sell climax on bar 4. We're probably going to pull back, but really important, you can see we have a 1 tick open gap with the prior day's low, meaning a lot of bulls, instead of buying below here, they thought, well, 3 straight bear bars, we might have to get to the prior day's low. And so what instead they did was they waited for here and then they bought on a limit order here. And if you bought on a limit order at the prior day's low, and again, there's daily chart traders doing the same thing, right? So generally when the market triggers a signal on the daily chart, if it goes past it, it does have to pull back. So even if we're going to get a bear trend from the open here, we will probably pull back to around this low because it's a signal on the daily chart, and daily chart signals usually don't go quickly without testing back to them. And keep in mind, it's a bull bar, so there's probably still more buyers below here than there are sellers. Bar 5, an inside bar. It's a low 1 short for the bears. They see, again, that we still have this open gap with the prior day's low. It's a low 1 short for the bears. It's an inside bar, but it's a big doji bar. So the good thing for the bears is that they still have the open gap with the prior day's low. I think that's really important. However, the reality is bar 4 is a really big sell climax. And if you sold the close of 4, you are not thrilled with the way 5 looks. So as much as, bar 5 is a bear close, it's still more of a doji bar. And it's probably going to end up being, it's a low 1 short really deep in a sell climax. It's really not all that great. There's probably more buyers below 5 than there are sellers. And then we get bar 6, a huge bull bar closing near its high. Now, this kind of pattern, I treated it, I saw it as a potential inside pattern after a sell climax. And I know what you're thinking. You're like, well, bar six is not an inside bar. And that's true. And it's not really even all that close to being an inside bar, but the pattern looks the way that a lot of IIs look on the open after a sell climax. So I thought the setup for the pattern, the context of the sell climax, and then one inside bar, and an attempted essentially inside bar on bar six, I thought the context was pretty reasonable for that sort of pattern. We didn't quite get it, but just because we didn't quite get it doesn't mean the market won't trade like that kind of pattern. So, sorry. So an II after a climax, I have a couple examples, not too many, but this one was from a few months ago. You can see we got the sell climax on the open and then an inside bar 11 and 12, and you can take the buy and just basically hope it's the low of the day, betting that bears are going to exit. This is a final flag, and then we're going to get some sort of bull channel up. Obviously, this day ended up being pretty strong. This was, I was just something over here, buy climax, and then an inside pattern. Not on the open though. I really should reserve this folder for just patterns on the open, but it obviously didn't here. This was today. And then here's another good example. I think this is the more likely scenario whenever you get an II after a sell climax, where the market's going to go more sideways to up, because the sell climax still has effect. Obviously over here, we ended up getting a strong bull trend day, but I thought that was more rare. And I thought more often you're going to get a channel upwards like we did here, where it's difficult to hold the whole way and the market's reversing on you a lot. But if you do hold, you will end up making a relatively good profit. But anyways, long story short, I thought bar six was a reasonable buy, taking a chance that it's the low of the day, even if you don't want to look at it after an inside pattern after a sell climax, which is a reasonable thing to do. Think about it, or reasonable to not look at it that way. Think about it this way: just sell climax on the open and big reversal up bar six. So sell climax on the open, bull surprise bar six. If you sold above bar five, what do you think about bar six? Well, you don't like that. If you sold above five, you were hoping bar six was going to end up, finding sellers above, or we're going to find sellers above five during six. And instead, you get a bull bar closing near its high. If you're short for any reason on bar 1 through 5, you're going to be getting out above 6. So it's going to be a reasonable buy. Some traders see 6 and they see, well, big bar, big risk. It's reasonable to buy, but I think I would rather wait and see if I can get a chance to buy lower. But unfortunately, when a lot of traders are looking to buy lower, a lot of times you don't end up getting the chance to buy lower. So a lot of traders were hoping that we were going to end up getting a pullback after 6, and then they could buy some sort of reversal up. But instead, a lot of times what will happen is the market will just start the rally and go straight up instead, because traders do not. Because when you have a big bull bar like 6, there's probably buyers below it anyways. So it's not as risky to buy above, because you're going to be able to add on lower. And then you're at the worst case scenario, you buy here, you buy more here, or not the worst case, but most likely your worst case scenario is buy here, add on, and you're going to be able to get out without a loss. There was another good example of that sort of situation occurring on, I just sometimes look at random stocks when I'm bored, and I was looking at Boeing yesterday during the afternoon, and I think this is another good example of that. You get enough bear bars here that this is a small doji bull bar, but you get enough bear bars here that you're not sure that the first reversal up is going to work, but traders know that we're probably getting back to this close. And as you can see here, this was a reasonable buy as well. The traders scaled in. They used this tail to get out of their longs. And so traders know we're probably at least getting back to this close. So when they see another good bull close, what do they really want? Well, they really want to buy a reversal up from down here. But we have consecutive bull closes. We're probably getting here. And this is a really good bull bar too. So even if we do go down, we're definitely getting back here. So you can buy here, and it's less risky knowing you can add on lower, and you're probably going to get some sort of reversal up. I do only trade the Emini, but sometimes I just look at stocks and when I'm bored and look for patterns. So bar 7, somewhat disappointing bar if you bought above 6, but I think also if you bought above 6, you weren't expecting the market to rocket straight up. Your best case scenario, which was probably what happened today, is for the market to move up in some sort of tight channel. You know that you're probably not going to get just a huge rally immediately that undoes everything that 1 through 5 did. So we might have to go a little bit more sideways to up. Bar 8, another bull bar, but a tail on the top. So again, it could start to move up in a tight channel. And when you see 6, 7, and 8, a lot of traders are starting to think, well, we might end up not getting the pullback that you're hoping for. Because at this point, it's probably not a bear trend, right? 6, 7, and 8, 3 straight bull bars, and 6 a big bull bar closing near its high. So you know that the bears are probably not going to get a bear trend. And if the bears are probably not going to get a bear trend, then this probably might have to be either a trading range or some sort of bull trend. And if it's going to be a trading range, you know you can buy this close and scale in lower and still make money. Additionally, bar 8, you can see some traders, they didn't buy above 6, they wanted to see follow through first. And even if they saw 7 and decided 7 was enough follow through for them, so on the close of bar 7, some traders probably placed a limit order to buy one tick above the 6 high, basically trying to get in. They were worried 6 might have been a trap. So what they did instead was waited for follow through, which is 7. 7 is follow through. It's not great follow through, but it was enough follow through for some traders to try and place a limit order to buy, get in at the same entry price after having a bit more information. Those traders were never let in on 8. So now those traders might be worried that they're going to miss out on a bull trend. And so they'll start buying closes like on bar 8, which continues the rally onto bar 9. 3 straight bull bars. 9 is a little bit climactic, but we're probably, I would say we're always in long at this point. We're probably going at least a little bit higher. A doji bar on bar 10. Disappointing for the bulls, but I think that, probably buyers not too far below 10 if we do trade below it. Ultimately, this has done enough damage to the bear case that this is not going to be a bear trend. This is going to be either a bull trend or some sort of trading range. I think that, again, with the context on the daily chart, the odds of a bear trend have decreased a lot. Bar 11, a bull bar closing somewhat near its high. It's a good looking bar. You can buy above 11, but my big problem with 11 is that 10 is a bear doji bar. So if you're buying up here, it's a tight channel. Yes. It's a bull micro channel. Yes. 1, 2, 3, 4, 5, 6, 7 bar bull micro channel for the bulls. So good for the bulls. A tight channel up. Yes. So a lot of good things going for the bulls. However, some issues with 11 in the fact that, how much higher are we really going without a pullback? The most recent sell climax high is here. So if you're buying above 11 and you know that 10 was just a bear doji bar, you're probably hoping that 12 is a really good looking bull bar closing near its high, but you're also buying relatively near the moving average. So it's a bit of a tricky trade. And if you buy above 11, honestly, 12 is not the follow through you wanted. If you bought, you probably wanted more than just a doji bar. You probably wanted to see some sort of better bull bar. Is 12 still follow through for 11? Yes, it's still follow through for 11. However, a lot of bulls taking this kind of trade, this high in the trading range, are going to be pretty particular with this sort of trade. And they're going to look to potentially exit their longs around break even after 12. Again, had 12 been any sort of bear bar, I think that bulls are going to exit immediately below it. So, you could argue, you could think of it as if you had bought above 6, it's still reasonable to be long above 11, right? But you're going to exit below any bear bar. If I'm buying above 11, I'm probably not using a stop down here. I'm just putting my stop below 11 because reality is your premise, if you're buying above 11, is that we're going to continue up in a really tight channel and we're not going to pull back, which is what we did. This was your premise, basically, if you bought above 11. But it's a dangerous trade because you are buying relatively high and you can definitely get trapped on this sort of trade. So I think if you're buying above 11, you just put a stop below 11. And if you get any sort of bear bar on 12, let's say you get a bear doji on 12, like something like this, you probably just get out at break even if you can. When you get a bear bar closing near its low 12, you just get out of the trade. It's not really worth staying in because the pullback could be rather uncomfortable. 13, another doji bar. So again, if you bought above 11, 12 and 13 are not all that ideal. You were probably hoping to see better follow through, but it's still okay to be long. We're still always in long and there's still bull closes. So although we are starting to fail at the moving average, it's still okay to be holding long, hoping that we get a breakout through the moving average and go up to at least the high of the day. 14, a bull bar. So good for the bulls. Again, we're probably going at least a little bit higher. I'm not sure how much higher. This is getting pretty climactic, but still good to be long. And then a surprise bull bar up. Sorry about that. A surprise bull bar up on 15. Do you buy the close of 15? I wouldn't. I think that you're buying really high here. Probably better to take some profits on the close of 15. If anything, if you bought above 11 or you bought above 6, definitely I think better to take a piece off. I'm just curious about something. What was this high? Okay. That's kind of interesting. So the market needs to go 20.5 points in order for traders to make a 20-point profit, because if you're buying above 6, you're buying one tick above 6. And the market needs to go one tick past your limit order, which would be at 20 points, which is right here. So the market has to go one tick past your limit order in order for you to make money. So basically you need a one tick gap, or you need 20.5 points from the high of bar 6 for your limit order to get filled. And you can see we went exactly 20.5 points on bar 25, showing that traders who bought above 6. Why is 20 an important number? Because generally right now with the size of the market, swings are about 20 points. Usually the market gets a swing every day about 40% the size of an average day's range. And the average day's range right now, I don't track it anymore because I just have a feel for it at this point. But I used to keep track of the past 20 days and what their ranges were. And then I would just average them out every morning. So I would know exactly what the day's range was. And then if you do that, you can just take, so let's say the average range is like 72 or something. You can just take 40% of that and then round to the nearest 5, which is what I would do to figure out generally what I thought an average day swing should be. But you can see buying above 6, the traders were able to make exactly 20 points during bar 25, which is really important. And that's why there were sellers there. But I'm getting ahead of myself. So 15, a climactic bar. I would take some profits if I was long. And that's exactly what happened. That's why we got the pullback on 16. Traders, you can see, more interested in buying a pullback of 16 than buying, or 15 than buying the close of it. 17, I think bull surprise. We might go a little bit higher, but first leg up and then a bear bar pullback, second leg up and then a bear bar pullback. So if you're buying above 17, you're buying a third leg up. And I don't think it's all that great to be buying third legs. This might be forming some sort of parabolic wedge. Now, it is a bull micro channel from bar 6 to bar 17, or I guess 18. So, right, 18 consecutive bull bars, probably going at least a little bit higher, but third push up, so possible parabolic wedge. So hard to buy up here without scaling in lower. So when you get that sort of parabolic wedge, you have to expect at least 2 legs sideways to down. However, the market is in a 12, 13 bar bull micro channel. So there's going to be buyers below 18. No one's going to really sell below 18. But you do get a strong bear bar closing near its low 19. I would not sell 19. I would get out of my longs below 19. Is it true that we'll probably get back to the 18 close later today? Yeah, that's true. And we'll definitely, I think, get back to the 18 low, but I don't think it's worth staying in the trade. If you bought anywhere along the way, I would probably just get out below 19 and look to buy again after a couple legs sideways to down, maybe 10 to 15 bars, and then or a couple of hours. 20, follow through for the bears, but it's not really all that good. I think it's just closing the gap with the one high, basically. So we traded back down to the one high. We did have an open body gap here for a while, and it's noticeable, something that was a little bit strong, very subtle, but a little bit strong for the bulls, is that we never closed this gap, and we never closed this gap. It was kind of a given that we weren't going to close this gap, but this gap was opened a bit later, and you can see we tried to test it. The bears tried, but they were never quite able to, which made it a little bit more likely that the bulls were going to continue the rally, because we now have 2 small open gaps, which means a little bit of an increased chance that we're going to end up getting some sort of bull trend in the second half of the day. If you only have 1 open gap, in general, if you only have 1 open gap, the odds are that it's going to become a magnet later in the day. And if you have 2 open gaps, though, odds are that it'll end up being you'll get some sort of second leg up from this, right? So the bull trend will continue. Bar 21, a bear bar, but yeah, it's 3 straight bear bars. So whenever you get, pretty tight channel down from 19, 20, and 21, it's 3 straight bear bars. So we're probably going at least a little bit lower, but at the same time, we have such a strong bull channel up that we're probably not going that much lower. So by a little bit lower, I more mean a second leg sideways to down. 22, a bull bar closing near its high. It's a high 1 for the bulls, but I think that we're going to get a second leg sideways to down. So I'm not buying above 21 or above 22. If you do buy above 22, I think the way you manage it is you either buy and you look to scalp out at the 18 close if you get it moved right to the 18 close, or you have a pretty wide stop and you're buying more. Let's say you get trapped on 22, you probably do not exit below 22. You add on below 22 and then look for a rally back to the 18 close if we go straight there. But if you buy above 22, I'd probably just scalp out up here, because the reality is 19, 20, and 21 is probably going to get a second leg sideways to down. And this probably isn't going much higher without going sideways for a couple hours first. So it's okay to buy above 22 because you have protection essentially in the fact that you were probably getting back to the 18 close later today. So that decreases the probability of you taking a losing trade here. But you also have to be willing to add on below. It's really not a very good trade, and the management's probably going to be pretty difficult. 23, follow through for the bulls, but a tail on the top, not all that ideal. Again, after the 3 straight bear bars, I do think we're getting a second leg sideways to down. Follow through 24, but again, the tail on the top, not really all that ideal. And then 25, you can see we traded back up to a new high and we failed. Why do we fail at the new high? Well, if you bought the close at 18, you were probably disappointed in the sell-off. Some algorithms bought the close of 18 and did not exit below 19, and they scaled in lower instead. I would not personally recommend doing that, but some algorithms will do that. And they used the rally up to the bar 18 close on 25, or the rally to the new high, and sold it. Additionally, bear algorithms know that they're going to get a second leg sideways to down. So they'll sell the breakout above 19 as we trade above 19 during 25 in order to betting on the fact that we're going to get a second leg sideways to down. And that's what happens on 26. Or that's why there's sellers on 25. 26, a bear bar, so double higher high, double top, 19, 25, but 26 is not really a very good sell. It's a bear bar, but a tail on the bottom. Again, I'm not really looking to sell. If you're going to get a sell, or if you're going to sell, you know it's going to be a minor reversal at best. Basically, what you got is one of your best case scenarios here. So I'm not really looking to take any sort of short here. I'm more looking to buy, to get long after a pullback, especially if the gap between the 10 high and the 12 low stays open. 27, a big bear bar, but a tail on the bottom. And you have to be thinking now, when did this trading range start, right? So we got a pretty strong move up, but when did the trading range start? And generally, when you get doji bars, those become the starts of trading ranges. So it could have been here, the bar 10, or bar 10, but I thought that would be a little bit too low. We probably weren't going to pull back quite that deep. So I thought reasonable, if we were going to get a second leg up, bar 12 low would have been roughly where the bottom of the channel was. I know we tested exactly to the 13 low, but I do think the bottom of the channel was seen as the 12 low. We just didn't quite test it. 28, an inside bar, a low one short for the bears, but this really isn't all that great. You can see if you're selling here, you're pretty much just selling on a channel line. So I think that, this is probably going to be sideways down for another leg or two. But ultimately, you have 4 straight bull bars here. So we're probably getting back to the bar 25 close, the same way we were probably getting back to the bar 18 close. So I'd imagine we're getting back to the bar 25 close, or at least the bar 25 low, since the traders who bought below 25 after 4 straight bull bars did a pretty reasonable thing. And they haven't been let out yet. So I think we're probably getting back to that point. 29, you can see disappointing follow through. So if you sold 28, you wanted a strong breakout below the 27 low, and instead you get 29. So disappointment. So traders are probably going to use 30 to exit. Would I sell 30? No, I think you're selling potentially a third leg down, and this is definitely more of a leg in a trading range than anything else. 31, a bull bar closing near its high. Can you buy above 31? Yeah, I think you can. But the thing is, the channel down from 26 to 31 is pretty tight. So, what am I going to say? I'm going to say you can buy above 31 because this is really strong and we're probably getting back here, but the channel down is tight and we might need one more leg down. So you cannot buy above 31 and put a stop below 31. What you need to do is, if you're buying above 31, you need to have a stop, basically a measured move down plus 2 or 3 ticks. So somewhere down here is where you need your stop. And you probably buy a smaller position above 31 in case we get a vacuum up and we test back to this low pretty quickly. Then you can use that to get out of your trade. Or I think better, you buy a small, or what I meant to say was, or you buy a smaller position above 31 and you add more below 31 because you know that there are probably buyers below 31. And the traders who buy above 31 and use a wide stop and are willing to buy a little bit more below 31 know that they're probably going to get a reversal up. But it's a tough trade. It's kind of a tougher trade to take. It's better to just trade on stop orders if you're newer. But the reality to trading is that everyone ends up doing things like that. Everyone ends up trading on limit orders before they're supposed to. Everyone ends up doing all sorts of things before they're supposed to. So, while I say that, and I'm hypocritical too. I did that today, and I tell myself I'm only supposed to trade on stop orders. So I'm no better. I do the same stuff, but I also just recognize the reality that traders are going to do what they're going to do. So I think okay to take the buy, but you have to have a wide stop, moral of the story. Doji follow through bar 32. It is follow through for the bulls, but it's really not all that great. It's more of a pause bar than anything. Again, makes me think still probably more buyers below 31, but we're probably going below 31. 33, a bull bar closing near its high. There's a chance we get a vacuum test of the 25 low, but I would not buy above 33. I think the buy was 31 or wait. And if you're buying 33, definitely wide stop. That 31 through 33, it could have been 2 legs up. So 31, pause 30 on 32, and then bar 33. But there's probably buyers below 31 if we get there. It's some sort of wedge attempt, you could argue, 17, 22, and then 31. And bears are going to try and get a breakout below it. but I think probably only 40% chance that that breakout succeeds with how strong this was up. So 34, a bear bar, but a tail on the bottom and a tail on the top. Some bears would argue it's some sort of wedge pullback to the moving average, but I don't really think it's all that great. It's a pretty weak argument. They hope double top 30, 34, neckline 31, and 40% chance of a measure move down, but the trader's equation is not all that great. And you can see we got buyers below 31 during 35, so we got a big tail 35 and a reversal up 36. Do you buy above 36? I'd probably wait to see if we get consecutive bull bars, but you are in the area where it's becoming, you're looking for a reversal up on a stop order, and you can just buy above 37 if you want. That's why trades like 31 where you're scaling in can be a bit tricky. And a lot of times you're just going to get a reasonable stop order a little bit later anyways, rather than taking the buy above 31 and trying to scale in. Basically all you're doing is saving yourself the occasional vacuum test and profits. So probably for most people, better to wait until you get 37 and then just buy above 37. The problem with 37 is, there's probably some traders who bought the close of 33 who scaled in lower and are you going to use this bounce to get out of their longs, and you're buying right on the moving average. But again, the magnets above are pretty strong, so I do think we're going higher. A doji bar 38, so it's not ideal follow through for the bulls, but it is still follow through. But it's a bull doji, right? So still some follow through, and then a bull bar closing near its high 39. We're testing the 28 high, which is probably, you could argue, spike 26, 27, and then channel down from 28. But again, we're testing the top of that. Again, I don't think it was the best argument in the world, but I do think you could argue spike and then wedge channel 1, 2, 3, and we're testing back to that high. 40, a bear bar closing near its low. I think if you're long, it makes sense to get out below 40. That 40 is probably strong enough for a second leg sideways to down. But 36 through 39 is making this a minor reversal. It's true we're still probably getting back up here, but I think it's hard to hold after you see 40, such a big bear bar. And you get disappointing follow through on 41. So would I buy above 41? I probably would not. It's a high one for the bulls, but it's a really small bar, and it's really tricky to do that. Follow through for the bulls on 42, but a tail on the top and a tail on the bottom. Again, I think, we're probably going to get to the 25 low, but sometimes you just need to let the market go without you. And then big outside up 43. And where was the second leg down from bar 40? Well, you got it on 43, this tail. Huge outside up bar 43, because once we started to rally, traders bought the market thinking we might end up going here. But again, big tail on the top could be some sort of wedge, 1, 2, 3, truncated wedge, I suppose, because this is a little bit lower. It ends up trading higher, so it becomes an actual wedge, but you don't know that in real time on 43. 44, possible, you could argue double top or wedge, or triple top is probably, triple tops are basically just wedges. It's the same forces, but it just looks a little different. You can call it whatever you want though. 44, a bear bar, but a tail on the top and bottom. Bears were hoping to sell 44, betting that it was going to be a bull trap, but instead you get a disappointing tail on the top and a disappointing tail on the bottom. This is still really big, but this is the dominant feature of the day. So as good as this was for the bears, I think that this is a lot more dominant. So in trading ranges, a lot of times, the traders who sell the close of bar 4, reasonable thing to do. It's not good, but it's theoretically reasonable. And those traders would be scaling in, betting that we're going to at least get back to the midpoint of their next entry and the bar 4 close. You can see those traders, they had an 80% chance of being able to get out, but they were never able to. And it could just be part of the 20%, but I think once you get such a dominant feature, 6 through 18, it kind of invalidates a lot of that argument for the bears who were selling from bar 1 to bar 4. 45, a second leg sideways to up from 43, but I think, triggered above the high one on 44. But if you wanted a bull trend here, it probably needed to be a little bit better. 46, a bear bar closing near its low. It's high in the trading range, and it is the wedge, so you can probably sell 46, but I probably wouldn't. I'd rather wait to see if you get good follow through, which you do on 47. But now it's big bars, big risk. And a lot of traders end up scalping out. So what about 48? 48, it's a double bottom. So basically a higher low double bottom from 43. And you can buy hoping the second leg up from bar 6 to bar 18 has started. It's bar 48 and that we've been in a trading range for the past 30 bars exactly. So at this point in the day, you have to be saying to yourself, we'll probably get one more swing trade today. And 48 is a potential candidate for that swing trade. Problem is you're buying after consecutive bear bars towards the middle of this trading range, but we are always in long. We never quite really flipped to always in short. say we mostly stayed always in long for the whole day after bar 6. And so reasonable to buy above 48, closing above the moving average, but it is definitely a swing trade. Follow through on 49, but a tail on the top. Reasonable to be long. Some traders waited to see the follow through and then they bought the close, causing 50. Again, a small open gap here. And then 51, a doji bar, so we were never able to test the 48 close, meaning the traders who waited for some confirmation and tried to buy on a limit order were never let in. 51, a doji bar, so a bit disappointing, means the buy the close might come to an end relatively soon, but still always in long, still okay to be long. Follow through on 52 for the buy above 51, or sorry, no follow through on 52 for the buy above 51. 51 is an inside bar, it's a high one, but you're at the top of the trading range. I'd rather wait and see the breakout, and you get disappointment 52. And then a bull surprise 53, and an inside bar high 154. So what is this looking like? We have one buy climax and then a pause 52, 53, or sorry, 51, 52. A second buy climax 53 and then a pause 54. It's a high one inside bar. But if you're buying up here, what are you looking for? You're looking for a third buy climax. And you're not going to make that much money on 55, but that's what you wanted. I think if you bought above 54 was the third buy climax, because now it's a parabolic wedge. 1, 2, 3. Excuse me. Hold on. So a lot of traders bought the close 54 or bought above 54, and they got 55, better than 2 to 1 of their true risk, or about exactly that. And so they said, okay, good enough. And then they just exited on the close of 55, and that's what's causing 56, parabolic wedge top around yesterday's close. I did think we might have to get here, and it was reasonable to think we might have to go outside up, which we do, or which we did. But again, that's what's causing 56 is bulls buying, they get the third buy climax and they exit. So that's why you get such a big bear bar at 56, the big bear surprise. Reversal up 57. Some bulls bought the close of 56, trying not to let it trigger, knowing other bulls will exit below 56. And 57 is kind of tricky because now you're betting on a breakout above a parabolic wedge. And a breakout above a parabolic wedge, probably usually a relatively 50-50 chance of succeeding. And in this case, instead of getting the measure to move up, so what do traders want? They want the breakout above the parabolic wedge, and they want a measure to move up to here. Actually, I guess we did get it at the very end of the day, but it seemed more likely when you get something like that you might just get a leg 2 move. The whole day got a big leg 1, leg 2 move. You can see it was into this area where we started to stall. Follow through for 57 on 58. It's not really ideal follow through if you're buying this high. Your risk is kind of big, but it's okay to be long. I think it was difficult to buy because 46, 47 was really big and 56 is really big. The bulls are doing a good job at undoing the damage the bears have done, and that's been a common theme all day. 1 through 5, big bear move, but the bulls undo it with a strong rally. 46, 47, really reasonable bear move, but the bulls again undo it with a strong rally. Huge bear bar 56, bulls completely undo it 57. So it's reasonable to be long here. The bulls are doing a good job, but you're still getting reasonably good bear moves. But again, we are getting open gaps. Oops. For the bulls. So probably still going at least a little bit higher. You can see we ended up getting another one here. So 59, more follow through for the bulls, a good bull bar closing near its high, and more follow through on 60. These are by the close bars, 59 and 60, yes, but at the same time, you're getting really, really high up. So they're probably quick scalps. If you're buying above 60, scalp out for, 3 points or something. A lot of traders did, or just exit on the close of 61 or something. It's not really all that great. You can be betting on the second leg up, but if you're doing that, don't exit below 62. Traders instead use the rally up on 63 to exit their longs. Some traders were buying these closes knowing that the trade was probably not going to go straight up. They buy more maybe below 61 and use the bounce on 63 to scalp out of their trade. So it was a reasonable buy below 61 as well, but it's probably a scalp because this is not going to go that much higher. 63, a bear bar closing near its low, but no one's selling after this much of a strong move up. Disappointment 64, so buyers below 63, and then a second leg down from 63 during 65. 66 is a high too. You probably can buy 66, but it's just so late in the day, and we've already had such a protracted move up that I think we're probably going to be more sideways, so it's probably more of a scalp when you get the move up at 67. Maybe if you're lucky, you get to the new high of the day, but the odds of this turning into a strong bull trend are not very good at all. We probably need to go sideways for a little while first. And then you can see bulls exit causing 68. The remainder of bulls who did not exit on somewhere during 67 or exiting below 68, causing 69. And again, same thing. I probably would not buy above 72 or would not buy above 73. It's just too late in the day and I'd rather be done. And, outside pattern 77, but better to let it go. But OOs and OOs, outsides in general, have a 60% chance of getting some sort of measured move. For stop orders, 2 was probably reasonable, but not ideal. 6 is good. 11 is good. Again, third leg up if you're buying 17, 18, so that's tough. 22 with a wide stop, but I'd rather just wait. 31 with a wide stop, pretty solid. 37, probably fine. 46, probably fine. 48, pretty good. By the close, I suppose 50, but at the top of the trading range. And then 54 maybe. And you don't really have to exit. If you buy above 54, your stop's probably a lot lower. And you get out below any bear bar. So you're willing to get out below 56, but it never triggers. 57 probably, and then 60, 59, 60 by the close, but it's more of scalp. And again, maybe you do something later in the day, but I think if you're taking trades like 66, you've missed the point of the rally. So I probably would not do that. So big leg 1, leg 2 day for the bulls. IO, inside bar, outside bar, inside bar, outside bar. What it really means is that we're really just going sideways in the market before the FOMC meetings usually goes sideways. And if I'm not mistaken, I do not believe that I am, but I'll check. There's an FOMC meeting tomorrow. Yeah, so there's an FOMC meeting tomorrow, so the market's probably going to go a little crazy around 2 p.m. Eastern Standard Time. So, I'm not really going to give an analysis on daily, weekly, or weekly charts. I think it's better to just wait for tomorrow because whatever happens tomorrow, it's probably going to be a surprise of one direction or another. Is pretty common. So we'll see. Maybe we get, bulls are arguing that, this is a failed breakout below the IOI and we're going to try and get a breakout above. And we are probably going to try and get the breakout above. You can see we broke slightly above the top of the pattern, but the question is it going to be a successful breakout? So bears seeing some sort of maybe top here, a wedge or something. But again, I think tomorrow, usually when you get FOMC days, the market does something dramatic. So I'd rather just wait and see what it's going to be. Yeah, that's the day.